Hey everybody, this is Mitch Ferraro from F Street. I hope everyone's having a great day out there today. I'm super pumped to have this conversation. I don't get this often that I get to talk with one of our principals here, Nick Jung. Who am I kidding? Nick Jung and I, we talk like every day. But I'm super excited to have this conversation because we are acquiring another industrial building, and it is a really, really great asset. And I got Nick on today because Nick is like our go-to guy on everything from our industrial acquisitions, multifamily developments, industrial development. He is the guy that is basically putting everything together so that when we are putting these investments out to you, the investors, he's the one making sure that it's a great investment for you. So Nick, thank you so much for your time today. Super appreciate it. So this is our Bear Creek deal. So I want you just to kind of start giving us what this deal is, what it looks like, why we like it. And I'll kind of go through and kind of ask some questions to give our investors an idea of what this is.
Love it. Thanks, Mitch. Yeah. F Street Bear Creek. Let's go over why it's Bear Creek, first of all.
Yeah.
This is actually an industrial acquisition in Hannibal, Missouri. We figured F Street Hannibal, probably not the best LLC name or opportunity, but it's right next to Bear Creek. When we visited last week, we learned that Bear Creek is just north of this site, so that's actually where we drain into.
Nice.
So we love this opportunity. So it's a 470,000 square foot industrial opportunity, Hannibal, Missouri, right off of Interstate 72. Cool. Hannibal, most known for Mark Twain. So if you ever go visit their tourism, all Mark Twain. But what's the number one employer there? General Mills. So why we love this facility is it's obviously a large distribution facility to support the General Mills production facility.
Yep.
What General Mills produces here and why we believe they're going to be extremely sticky in this very specific location is General Mills recently put in $50 million into this facility.
Yep.
They closed 3 other facilities in Missouri, which consolidated and expanded here. All Progresso soup is made here. Yeah. So if you love Progresso soup, got to learn a lot more about Progresso soup as we dove in. Obviously, Campbell's holds the market, but Progresso with General Mills is their innovative soup. Yep. So that's all produced at this facility, Old El Paso taco shells and Old El Paso spice, in addition to Nature's Valley. Yep. So really like 3 major food groups for General Mills as a multi-billion-dollar Fortune 250 company.
Yep. Yep.
So why we love this building specifically is General Mills is in here for another 7 years. Okay. We've got 7 more years of lease term. And with that lease term, we have standard bumps, and they're not going to move. Yep. When we visited the site, you look at the building, very well done building. Yeah. The building itself was originally, this is the coolest part, it was done on a handshake with General Mills without a lease almost 19 years ago. Wow. And the current seller was the original developer. He actually owns the trucking company that used to do 18,000 truckloads to this facility every single day. Yep. He's retiring, looking to get rid of the site. They expanded from the original 200,000 square feet, added another 250. Yep. So, and that was only 9 years ago. Okay. So great newer building. Yep. We're buying it at $27 a square foot. Yep. I mean, a building like this is going to cost anywhere from $80 to $100 a square foot all in to build. So you're buying well below replacement, Fortune 250 tenant, and just a great spot. Yeah. I mean, it's not in one of your major metros. It's not in Indianapolis. It's not outside Dallas, but it's truly on the Chicago, Kansas City Expressway. Okay. So we're Highway 72 connects, I believe it's Highway 36, which goes all the way to Kansas City. So you're sub 4.5 hours from Kansas City, sub 4.5 from Chicago, only an hour and a half from St. Louis. So it's really one of these prime locations, centrally located, where if there was a backfill, I don't think General Mills is ever going to leave. Sure. Not for the next 20 years. Yeah. But if they would, it's still a very backfillable space. Sure. I mean, we can charge probably 30 to 40% below, and the deal would still be really successful. Yeah. Yeah. So I saw some pictures of the facility, very clean, very, very beautiful facility. Location is everything, right, in real estate. This is in a great spot next to the interstate, Midwest type of area that we can get to. Another thing, too, is that, you bring up kind of the details of, like, this tenant being sticky, right? We use this term, right? Mission critical, my favorite and least favorite broker term. Yeah. So meaning that General Mills, it's someone that's going to stay in the building for a long time. We've got them on a 7-year lease right now. Do we think that maybe that'll extend at some point? I'm sure that's something that we will look at down the road, correct? Absolutely. the play on this opportunity is the reason we're getting it for what we're getting it at. I don't want to get technical terms, but we're buying this for over a 9 cap. So a capitalization rate, or if you take the amount of rent or net operating income we're going to get divided by the price we're paying, that's the capitalization rate.
Sure.
So we're paying over a 9 cap.
Yep.
And the reason we're paying over a 9 cap and why it didn't get bid down on typically a really good credit tenant like General Mills, why it didn't go lower, where I would typically see a deal like this trade a lot lower or higher in price, lower in cap rate, is it's a modified gross lease.
Okay. Which
there's multiple types of leases, but this opportunity specifically is not a what we call a net lease.
Yep.
Where General Mills or the tenant pays for 100% of everything,
yep.
maybe excluding the roof, structure, parking.
Yep.
Here, it's modified gross. So they're paying utilities,
yep.
but the new owner, F Street Bear Creek,
yep.
is going to pay the insurance. We're
yep.
going to pay the real estate taxes.
Yep.
But we're going into it knowing that.
Yep.
We have a really good idea what those are going to be. We have a ton of buildings throughout the country.
Right.
And we know the prior building financials.
Yep.
So knowing going then it, but that's the reason. On top of also, there's a nice 11,000 square foot second lease on the next Tran building next door, which, again, going back to the story behind this, which is there's always a story.
Yeah.
There's always a story.
Yeah.
Is the seller used to run the trucking company.
Yep.
So the next Tran lease here, which next Tran is the largest Mack truck repair company in the United States.
Yep.
They bought it from the seller. And this is the truck repair facility for the 18,000 plus trucks going in and out of this facility every
That's
day.
perfect.
So, but that's also why a lot of these major groups aren't going to buy a deal like this.
Yep.
It's we'll call it, I hate to use the word difficult or tough, but it's, or yucky,
yep.
you know, as my kids might say, but it's not easy. And that's what we love is
right.
we can create value for our investors
yep.
because of that.
Yeah.
And our goal here is we know we're going to get major cash flow on this
yep.
just because of where we're buying at, the leverage we're going to get. And we'll be able to pay that down with Fortune 250 credit for the next 7 years.
Yep.
And whether it's year 4, 5, 6,
yep.
we'll look at talking with General Mills. Hey, do you want to extend?
Yep.
Or would you have an interest in buying the building? Because for them to build a facility like this, it would cost them twice the amount. They could just buy it for us or half of what it would cost them to build, and we'd still double what we paid for it.
Yeah, yeah.
So there's a lot of value, and this is their only facility. It's if you look at the building, it's a big building at 461,000 square feet.
Yeah.
The south side of the building is the packaging material.
Yep.
They take the packaging material across the street.
Yep.
They put the finished food product inside of it.
Yep.
Or the soup, or the Nature Valley bars, which I strongly enjoy golfing. And then they put it into the final packaging on the north side of the building.
Yep.
And then they ship it out to whatever facility it's taking from there.
Yeah, so this area is like a one-stop shop for
shop.
General Mills for this type of product, which is, great. Because again, like you mentioned, they had closed down some other facilities near the area. They've basically invested $50 million into this area. So it seems like this is going to be a super long-term solution for them for that specific product, which is awesome. Let's talk a little bit about numbers. Let's talk about preferred return. Let's talk about, the numbers that we look at for the investor that they may get if they wanted to invest in this deal.
Let's do it.
Do it. So,
All right.
So what's our preferred return? What is our, what are we looking at from, just talk a little bit maybe more about, the long-term hold of this position of this investment. Give us what an investor might want to hear when doing this.
Perfect. So this opportunity, we're paying $13 million for the property. We're going to get leverage. We already have a lender lined up. So we're going to raise approximately $4.25 million. It's going to be our typical structure. So our investors make a 7% preferred return. They receive 100% of their money back next.
Yep.
Followed by that, it's a 50-50 split to the investors and F Street.
Yep.
Money trees, as we always call it. The hope here, like any deal, is whether we're selling or we likely on a deal like this, potentially look at a refinance sometime between year 5 and 7 when we get that lease renewal.
Yep.
Or that new tenant potentially, which General Mills is going to stay.
Yeah.
I could be wrong.
Right.
But I think it's a really good value proposition.
Yeah.
If we refinance there, investors get their 8% preferred return, and they have all their money back, and they'll still get that monthly check in the mail.
Right.
With all their money, they can go reinvest elsewhere.
Right. And then until we sell, basically, then it's again 50-50 split of net proceeds.
Exactly.
Yeah. Yep.
So, and one of the really benefits to this deal is we're buying it at a high cap rate, and it's a great tenant that we're going to have strong cash flow up front. I mean, we're projecting, based on the loan terms we have right now, we're projecting over a 13 to 14% cash on cash in year one.
Yep.
And then the year two, because we'll be IO during the first 12 months, or interest only. I won't abbreviate every time. After the first 12 months, we'll go back to, it'll be a 24-year amortization, and we'll be returning somewhere in the high 8s, low 9s in the first year.
Yep.
So averaging just over 10% over the first 4 years, and that jumps up even more in year 5, 6, and 7.
Yep. Yeah. So that's perfect. So again, this is kind of our general thesis on all of our deals, right? We're giving a preferred return. Anything over that preferred return is paying down the capital. Once you get all of your capital back, it's then a split of cash flow in the asset. For this deal, it's a 50-50 split. What I really like about this deal too, right? Because I know a lot of our investors have a lot of appetite for these types of deals. We typically can raise these very, very quickly. We're raising just over $4 million on this deal. I think what's really cool is that it's the end of the year, right? And a lot of investors might be looking for depreciation at the end of the year. What can they write off on taxes at the end of the year? So let's talk a little bit about depreciation. Let's talk a little bit about, why this is a good deal coming towards the end of the year here.
Yeah, I think that's a great point. I think with us closing this at the end of the year, technically we have to close on or before Christmas Eve, which will likely target December 18th. Targeting. That's still in 2025. And on buildings like this, where we know we're not going to be, this isn't a 12-month hold or a 24-month hold. This will be a 3 to 7, potentially longer term hold. We're going to want to depreciate it all up front. We're going to do a cost segregation study. We're going to bring that depreciation forward for our investors. And that'll be in the year 2025. So someone that might have significant passive gains in 2025, you'll really be able to take advantage of that in this year with an investment. And typically, it's hard to say, everybody's different. We haven't done the benefit study on this site yet, but on similar sites, anywhere from probably 30 to 40% would be coming back. So a $100,000 investor might get $30,000 to $40,000 in depreciation benefits or offset for the year.
All right, Nick, before we get out of here today, tell us, if there's something that we might have missed or that we're super excited about, just let our investors know or potential investors know, what is, before we leave, what's getting you going about this deal?
I love this deal. I think we've gone over most of the details of the deal. Maybe we haven't gone over the total raise we'll do is approximately $4.25 million. And I believe it'll fill up very quickly because it's a great opportunity for a lot of our investors and a lot of our potential investors that want that steady cash flow in an alternative asset where they can gain those depreciation benefits and where you have really, really stable credit. I mean, that's just, it's really one of those great deals. And the yield is really good. I mean, like I said, with a 9% plus cap rate, with the cash on cash you see just in year one, we love this opportunity. I love the building. I mean, visited last week. It's just a really well done building, and Hannibal's a great community. I mean, it's not somewhere typically somebody says, hey, let's go invest in Hannibal, Missouri, but its location off Interstate 72, with how close it is to cities, it is a great location. And they're paying below market rent. We're buying it for really expensive. It's one of those deals that checks a lot of our boxes and checks a lot of our investors' boxes, which is what we love. I will be investing in this deal. I love this opportunity. And like I said, everything about it so far we've really liked.
Awesome.
It is a bit unique just based on some of the way the tenants are set up, but that's where, again, we see that creation of yield that other investors might not see. And that's kind of talking about our exit on it. We haven't really talked about the exit on this deal. As we talked about, the exit's potentially with a renewal, potentially with restructuring the lease and turning it into a triple net lease.
Sure.
Even if that means we lower the rent a little bit and give General Mills a really nice sweetheart deal on it, that creates the value because you're going to a single tenant net lease. So STNL, We carve out the trucking center. You're creating a bunch of yield right there.
Yeah.
So we love the opportunity. I'm excited about this one. As I said, it did fall really nicely at the end of the year.
Yep.
I was excited to get it under contract finally.
Yeah.
So, yeah, I don't know. What other questions do you think?
Yeah, I mean, what maybe even too, like, what about just kind of the underwriting, right? So we know that it's a gross lease. Like, how are we underwriting this deal to make sure that we're, going to be forecasting the right expenditures at the end of the day?
Absolutely. So this one, we're being a little bit conservative up front when it comes to our CapEx reserve or capital expenditure reserve. And because it is a gross lease, modified gross, it's not actually gross.
Yeah.
It's a nice lease with General Mills. So because it's modified gross, we are paying for maintenance on the building. We're paying for the parking lot, the roof, any of those expenditures. We have a really good idea on those. We're being very conservative on our operating expense side of things.
Yep.
And on top of that, we already have the PCA, which is the property condition assessment. So we have a really good idea of what our short-term, medium-term, and long-term capital expenditures are. So, your big items: roof, structure, parking lot.
Yep.
Those are always the big ones. Siding, repainting the building, those happen. You always reserve for those.
Yep.
But as a amount of reserves we're doing, we're much higher than we usually are.
Yeah.
And we'll have $500,000 that we're going to hold in reserves up front. That's included within the sources and uses here that we'll have as we continue to build that. And I believe we'll be reserving 4% of 1.5. So we're reserving a significant amount. I believe the goal is to have in the first 5 years about 800,000 of reserves. And again, if we don't spend those, or we can send those back to investors, like that's where that money goes. It's there for the building and goes back to our investors in the event we don't need it or don't spend it.
Yeah. I think we've done a really good job today overviewing everything. Bear Creek LLC, Hannibal, Missouri, industrial acquisition at the end of the year. Get those depreciation benefits. If you do want to invest or you do want to ask more questions offline, one-on-one, please feel free to reach out to me, Mitch, M-I-T-C-H at fstreet.com, or Nick, N-I-C-K at fstreet.com, or we can get you in front of one of our development associates as well, Brian or Lane. Nick, thank you so much for your time today. I really, really appreciate it. We're super excited about this. We hope you as an investor would want to invest in this deal with us. If you are a current investor, always thank you for your confidence and trust with us at F Street. And if you are a new investor thinking about it, we hope you join us and we'd love to have you. Nick, again, man, thank you so much for the time. I really appreciate it.
Thanks, Mitch. Always a pleasure.
All right. Take care, everyone.